You want to be successful, don't you? Everyone does, but not everyone knows how to achieve success. That's why we're going to take a page out of the playbook of one of the most successful people on the planet, Warren Buffett. Welcome to Financial Psychology, the place to understand the mindsets of the rich and unlock your wealth potential. In this video, we'll go over 10 habits that have contributed to Buffett's financial success. Some of these habits may be familiar to you, while others may be new. But they're all worth learning and implementing in your own life. So let's get started. Number 1. Start early and invest for the long term. The first of Warren Buffett's 10 habits for financial success is to start early. And we're not just talking about when you're actually ready to start investing. Buffett recommends starting when you're still young and when you have time on your side to let your investments grow. Even if you can't spare a lot of money each month, it's important to start somewhere. That's because the key to successful investing isn't how much money you put in, but how long you leave it there. As Buffett says, the best time to plant a tree was 20 years ago. The second best time is now. Of course, if you do have some money saved up, it's important to invest for the long term. Don't try to time the market or guess which stocks will go up and down. Instead, invest in a solid mix of stocks and bonds that will give you stability and growth over time. Number 2. Take high-reward risks. Most people wouldn't dream of taking the kinds of risks that Warren Buffett does. But that's exactly what has made him so successful. He's not afraid to put his money on the line, even if the potential reward is high. In fact, he often seeks out high-reward opportunities. Of course, this doesn't mean you should recklessly risk your money. But if you're willing to take calculated risks, you could see some big rewards down the road. For example, investing in stocks can be risky. But when you invest your money wisely and make smart decisions, you can often see a better return than what you'd get from saving your money in a bank account. Real estate investments can also be risky, but if you purchase the right properties in the right markets at the right times, you can see huge gains. Buffett also emphasizes the importance of diversifying investments. Just as diversifying your stock holdings reduces risk and hedges against potential losses, diversifying your overall investments can help protect you from losses due to sudden market fluctuations. By spreading out your investments into different sectors, you can reduce the risk of losing a lot of money in one particular area. Diversification can also help you capitalize on different growth sectors. Number 3. Learn from mistakes. Nobody's perfect, and that includes the Oracle of Omaha himself, Warren Buffett. He's made his share of mistakes when it comes to money, but he's also learned from them. One particular example of this is his 2009 purchase of Burlington Northern Santa Fe Railroad. He paid $34 billion for the company, which is one of the largest financial transactions he's ever made. It turned out to be a savvy move in the long run as the company continued to grow and succeed. But in the short term, the stock price fell significantly, and meant Buffett had to wait years before the stock returned to its previous levels. The investment was a calculated risk, one that came back to pay off in the end, but it was still a mistake at the moment. The lesson here is that mistakes are part of the learning process. Buffett was able to take the tough lessons he learned from his mistakes and apply them to future investments. He realized that staying true to his value investing principles was the best path forward, not just blindly buying into stocks without proper research and understanding. He's also been very public about the mistakes he's made along the way, using them to teach other investors about the importance of taking calculated risks and constantly remaining informed. It's this kind of open mentality that has allowed Buffett to become one of the wealthiest people in the world. He's not afraid to own up to his mistakes, but he's also smart enough to learn from them. This has enabled him to develop a diversified portfolio of investments that have made him an incredibly successful investor. While mistakes are inevitable at some point, it's important to learn from them and use them to grow and improve as an investor. It's okay to make mistakes when it comes to money. Everyone does. The key is to learn from those mistakes and not make them again. That's why it's important to have a solid financial plan and stay disciplined with your spending. Number 4. Manage stress to stay focused. Want to know another key habit of Warren Buffett? He manages stress in order to stay focused. Buffett acknowledges that self-care in the form of meditation, yoga, and relaxation can help with staying in tune with your own body and honoring its needs. This can result in better decision-making, increased clarity, and overall financial success. Not sure where to start? Try setting aside time for yourself each day to take a few deep breaths or practice mindfulness exercises. It could be as simple as setting a timer for 10 minutes when you wake up and just sitting quietly in your thoughts. Whatever it is that helps carve out this quiet space of self-care. Use it as an opportunity to evaluate how you're feeling, what your mind and body are telling you, and reassess your financial motivations. Number 5. Make data-driven decisions. Are you someone who makes decisions based on gut feeling? Warren Buffett would certainly not recommend it. It's essential to make data-driven decisions if you want to succeed in any type of business or financial venture. Using metrics and data to inform decisions is essential to managing any business, but especially important in finance. Buffett is known for his look-back, not forward approach, which requires relying on the past performance of an investment before making a decision. By reviewing past data and trends, you can make informed, educated decisions about where to invest your money. Another important point for Buffett is to look for data that confirms an investment is worth making, rather than data that only supports an optimistic projection. It's important to look for evidence that is both positive and negative, and be prepared to adapt if the data shows that you were wrong in your original assessment. Taking the time to review data and ensuring that your decision is backed up by numbers is essential to making successful investments. Not only can data help you know when to invest, but it can also help inform you when you should exit an investment. Buffett recommends looking at the data over time to determine if an investment is performing as expected, and to know when it's time to sell. This means that it's important to use the data to understand the long-term performance of an investment and take into account things like market trends that could affect the value of the stock or asset. By making data-driven decisions and constantly monitoring the performance of each investment, you'll be able to make quicker, more informed decisions and capitalize on lucrative opportunities as they come up. Taking the time to do your research and understand the data before investing can be invaluable to your future financial success. Number 6. Think independently rather than follow the herd. The sixth lesson to learn from Warren Buffett is about being independent in your financial thinking. Buffett himself is known for making decisions that go against the rest of the industry. For example, his approach to stock investing is famously contrarian. Instead of following the herd and buying stocks when they're high, he waits until they're low and then buys them up. This strategy has enabled him to make a lot of money over the years and earn his place as one of the world's most successful investors. Buffett also suggests that it's important to do your own research before making any big financial decisions. Don't rely on others for advice. Try to study different options and decide which option is best for you based on your own set of beliefs, goals, and values. Finally, focus on what works for you instead of comparing yourself to others or getting lost in all the opinion noise that's out there. Developing an independent mindset can help you stay focused and make smarter financial choices in the long run. Number 7. Research investments carefully. One thing Warren Buffett is famous for is investing in companies he knows. He'll spend days researching a business before investing, and you should do the same. Learn all you can about a company before you put your money into it, and make sure you know the facts, not just what the company says in advertising. This will help ensure that you only invest in businesses that are doing well financially. You don't want to put your hard-earned money into a struggling business. If you're just getting started, take a look at some of our YouTube videos. We cover different types of investments, like stocks, bonds, and mutual funds, so you can get an idea of which type of investment makes the most sense for your goals and financial standing. Number 8. Don't let emotions drive decisions. If you want to be more like Warren Buffett and make smart decisions with your money, one of the key habits you must adopt is not letting your emotions drive your decisions. Emotions are one of the biggest investment killers and yet are so hard to control. Warren Buffett's strategy is to maintain his composure, no matter what his financial or market situation might be. He understands that in the long run, our emotions can have powerful and damaging effects on our investments. This will help ensure that you only invest in businesses that are doing well financially. You don't want to put your hard-earned money into a struggling business. If you're just getting started, take a look at some of our YouTube videos. We cover different types of investments, like stocks, bonds, and mutual funds, so you can get an idea of which type of investment makes the most sense for your goals and financial standing. Also consider enrolling in growing wealth-related courses, as well as increasing your knowledge around investing, so that when it comes time to make financial decisions, you have the confidence to do it without succumbing to emotional reactions. Number 9. Consider tax implications of investing strategies. The ninth habit of Warren Buffett's success is to consider the tax implications of investing strategies. Tax planning should be an integral part of any investment decision, and Buffett pays close attention to the tax code. He emphasizes the importance of having a tax plan in place to help maximize your savings and investments. For example, some types of investments may be more beneficial from a tax perspective if held for longer periods of time, such as retirement accounts or real estate. Additionally, certain investments may have different tax implications depending on your specific situation, such as whether you're investing for short-term or long-term gains. It's important to think about these details before putting money into any investment vehicle. Keeping the tax implications in mind can make all the difference when it comes to being successful with your investments. One of the most important tax considerations to make is understanding the difference between capital gains and ordinary income. Capital gains are profits made on investments or other financial instruments, while ordinary income is income earned through wages. Capital gains are usually taxed at a lower rate than ordinary income, so it's important to understand how these rates work and how they could affect your investments. Finally, it's important to consider potential tax deductions. Many investors have the potential to claim deductions on their taxes, such as deductions for certain investments, charitable contributions, and other expenses. Taking advantage of these deductions can help you reduce the amount of taxes you owe and save you money. Ultimately, tax planning should be an important part of your overall financial plan. Understanding the tax implications of different investments and taking into account the potential tax savings available can make all the difference when it comes to realizing financial success. Taking the time to understand the tax code can help you make smarter investing decisions and maximize the returns on your investments. Number 10. Focus on the big picture. The last habit of Warren Buffett is to focus on the big picture. This means getting clarity on your goals, both short-term and long-term. Once you know what you want, you can map out a plan to get there. Buffett emphasizes that it's important to never lose sight of your end goal and stay focused on it. He also reminds us that you don't have to be a genius or have an MBA to achieve financial success. All it takes is discipline, dedication, and hard work. So take some time each day to reflect on what you want in life and how you'll get there. Then create a budget, make investments, and track your progress. With these habits, you can set yourself up for success too. If you're looking for some tips on how to better manage your money and build wealth, you can learn a lot from Warren Buffett. None of these habits are necessarily groundbreaking or earth-shattering, but they're all simple, common-sense strategies that anyone can follow. So if you're ready to start building your financial success, start with these 10 habits from Warren Buffett. Thanks for spending some time with us today at Financial Psychology. We're so glad you did.